All right, good afternoon, everybody. We want to welcome you to our workshop. Thank you all for being here today. Thank you for getting out in this damp, cold we're not used to yet. Um, but it's coming, so we got to be ready. And we're thankful that we have lights on. So when we got here to set up, there was no electricity. So that's the reason we're running just a couple of minutes behind. We're trying to get all the electrical stuff back up and going. But we want to welcome you to Stone Rudolph and Henry's workshop, Understanding Your Tax Return. And we'll have David Fitch to join us in just a minute up there. I wanted to go over just a couple of things with you. I handed you a folder when you checked in. On this side, you will see a copy of the slideshow that he's going to be showing up here, and gave that to you so you can make notes for yourself to take home. And also, there's a handout on the opposite side that he's going to go over later. Behind that, you'll see a yellow sheet. At the end of the hour, we ask that you would fill that out for us, please, and that'll just kind of help us to know how to improve things or do things a little bit better. So appreciate that. And then also on each table, there are goodie bags. If you haven't had one of our goodie bags before, it's a lot of our little promo products in there. You're welcome to take those. If there's not enough on the table, we have some more when you leave for the day. The restrooms are through this door right over here to my left, and you're welcome to get up and get more to drink or dessert if you'd like to. Before I hand it over to David, I do want to let you know that next month our workshop is going to be on elder care. It's called Caught in the 10 Things You Need to Know About Elder Care. We've sent out the invitation already. If you haven't received an invitation and you're in, just go on our website under seminars, upcoming seminars, and you can RSVP through that port. So, other than that, we'd like to bring David Fitch. He is a member of our tax team, and he is also our audit supervisor. So, thank you, David, for giving us this information.
Thank you, Lynn. All right, and thank you all for coming out today. You know, we actually saw some snow today, and last Saturday with the storms, and Sunday was a beautiful day. And you just never know what you're going to get around here. But what do they say? Stick around a few days, and you'll probably be happy or maybe upset again. But anyway, we're here. We're glad that you're here. It's nice and warm inside, and hope you got yourselves a good lunch and ready to go to sleep now that we talked about taxes. So, now I could talk about this for probably days, but I'm going to try to limit it to an hour for your all's sake. But please interject any comments, any questions that you have. I'd like this to be interactive and educational. I want you all to get something from this if you can. So please, if you're wondering something, I bet everybody else in the room, or at least a few others, are probably wondering the same thing. So please interrupt me if you have any questions. I'd be happy to answer them, or surely someone in this room, we've got several of our staff in here, can help with that. Before we get into the presentation, just tell you a little bit about myself. I've been here with Stone Rudolph and Henry since 2010, and the CPA since 2011. I've been down in Clarksville, Tennessee, 10 years as of yesterday. I was born in Chicago, just outside of Chicago, Illinois, and don't miss the snow even when it comes. I'm not happy to see it. I'd be fine without it forever, but I can bear with it probably a little better than most down here, but I've gone soft now. So if it gets below 60, I'm ready to throw on the long sleeves. So anyway, that's a little bit about me. As Lynn mentioned, both do tax and audit. Whichever comes up, I'm ready to work and ready to help you all with whatever needs you have. A little bit about our firm here. Stone Rudolph and Henry. We were founded in 1954, so we've been around now for 65 years. We have an office both in Clarksville, right across the street over there, and in Brentwood as well. Of course, we know a thing or two about taxes and are happy to help people both plan and prepare their tax returns. We also aid in tax notices and audit assistance. Not that we want those, but they're kind of a necessary evil when dealing with the IRS. And as a CPA, we have the ability to talk to the IRS directly on your behalf, and we can help hopefully reconcile those notices and audits very quickly and without any more pain than necessary. We also provide financial statement audits, reviews, and compilations. If you have a business or work for a business and maybe they're trying to get a contractor license or they have grants that require audits, things like that, we can help add some assurance to your financial statements. And we also have a client accounting services department that kind of help with everything else. They help our small businesses with local filing, sales tax with the state of Tennessee. They're tangible personal property reports that come up, business tax license, all those little things that can kind of go unnoticed and end up turning into problems down the road. We try and help our clients get started off at the beginning, the right foot, and keep them going as needed. We also perform accounting services as far as we've got several QuickBooks experts on our staff, and they can do as much or as little accounting as needed, and provide financial statements monthly, quarterly, annually, so you can keep track of your business and know how it's performing. We also help with, as I kind of mentioned a little bit, some consulting and financial planning. We have a certified financial planner on staff. I don't see Brandon here, but he works out of our office Tuesday and Thursday, and the Brentwood office on Monday, Wednesday, Friday. And obviously, when you're planning for your retirement and working with investments, all those things have tax implications. So we talk and communicate with one another so we can make sure you're covered for retirement and that we're not going to get any surprises when tax time rolls around. And then finally, we also have technology support and monitoring. We have our own IT department that not only helps us, but helps our clients, goes out, helps them with their network, servers, fixes problems. I'm not going to talk about this much because I'll sound silly because I don't know what they do, but they keep people running and they keep us running, which is, yes, keep us most. Whoops, I just dropped my little mic thing. That's fallen off about 4 times, so I'm just going to leave it right there. Can you hear me all right, Tyrell? Still good? All right, cool. All right, well, let's go ahead and get to the most exciting part of the day, talk about your tax return. So we tried to gear this kind of chronologically as we go throughout the year to get an idea of how these things are going to impact your tax return. And we start kind of with some of the easy things. Some of these things you might know, you may not know, but how these all work together at the end of the year on your tax return. So first off, as far as generating income, you are either an employee or you're self-employed. So if you're an employee, when you first start, and we'll talk about all these things in a little more detail here shortly, but you'll get a W-4 form, which will lead to a W-2, and most people know what that is. You get it at the end of the year, give it to your CPA, and they're going to input it in the tax return. There's going to be some numbers on there, some taxes withheld, things like that. All that is if you're an employee. Your employer takes care of a lot of the hassle for you. They file your payroll tax deductions and all those things, whereas if you're self-employed, you'll notice at the end of the year you just get one or several 1099s with just usually a round number on it, and that's because there was no taxes withheld on any of that. So we're subject to self-employment tax, which we'll get to talk about these things a little bit in detail, but we're also eligible to offset some of that income with deductions, and also are eligible for the qualified business income deduction, as well as different retirement options as a self-employed individual. So first, let's start off talking about what happens if you are an employee. So, you get to your job the first day and they hand you a pile of paperwork that you have to go through. You thought you were actually going to work that day, but it looks like you're just going to be filling out paperwork all day long. The first thing that you probably see, or one of the first few, is a form W-4. A lot of people fill this out, and usually the HR department doesn't really know how to help you fill it out. They just say, please just fill it out, sign it, I got to have it. What it does is essentially tells the payroll department what all they need to be withholding, so at the end of the year when you fill out your tax return, hopefully the right amount is being withheld so you don't have a balance due. Now there's several items that play into that, and we'll look at those here shortly in your handout. We'll see some of the things involved on a W-4, but every time you start a new job, you're going to get one of these, and it's really just informational, but it's all plays into what comes out at the end of the year on your tax return. So I believe, here's a slide of what a W-4 looks like. There's not much on it. You got your name, your address, you sign and date it, and then you've got a couple of key spots there in addition to your social security number. You've got your single, married, or married but withholding at a higher single rate. That, as you know, on your tax return comes up whether you're single, married, or filing head of household or differently. So those, again, play into that number. And then on line 5 there, you can see the allowances you're claiming. And this has a big impact on how much is being withheld. So basically, for every individual or dependent in your household, you can put an allowance number there. Now, this is voluntary. You can put as many or as little as you want, but you do have to realize it has an impact at the end of the day. So essentially, the more allowances you have, you're telling the IRS, or in this case, payroll, you have more dependents and less tax due at the end of the year. So they're going to be withholding less. So the fewer allowances, the less that's withheld, the more chance you have for paying at the end of the year. So maybe, you have a little amount of income, you're the only one that's working, then you might not have any taxes due at the end of the year, so you want most of it during the year. Some people like to have a refund, so they have more withheld during the year. All it really is a timing thing. When the IRS is getting their money, either during the year or at the end of the year. But one of the biggest things that I run into with my clients, especially if there's a change in the job, maybe it's a husband and a wife, and the husband's already working. Well, the wife had a baby. She stopped working for maybe a year or two, and she goes back to work. Well, if he keeps his W-4 the way it is and she fills out her W-4, those two companies don't talk to each other. So they don't know that both individuals have income, and the rates that are being withheld on that W-4 are just for that person's income. So what I see a lot is people that are married filing jointly, if they only have those two W-2s, they're usually going to end up owing the first year because of the fact that that particular employer assumes that's the only income. So there's a way we can fix that. I don't know if I can go back. Let me go back a slide here. If you see on line 6, there's an additional amount that you can have withheld from each paycheck. And this is where we usually tell our clients to make the adjustment, because it's kind of a moving target if you start changing your allowances. It's just based on the tax withholding tables. But if we know, for example, that we were $1,200 underpaid, so we had to pay at the end of the year when we do our taxes, we can say, all right, well, we need to withhold $100 more a month. And that way we're not guessing. We know exactly how much additional is going to be withheld, assuming both jobs are the same, and we expect to make about the same amount of income. And that way at the end of the year, we're not paying. Nobody likes a balance due at the end of the year. And most people prefer a refund, and this plays largely into it, although very few people know much about W-4. So I thought we'd start with that just to give you an idea of what you're getting yourself into when you fill it out. Now, the nice thing about being an employee is you don't have to keep track of hardly anything during the year when it comes to taxes. Your employer, again, is filing all those payroll deductions each pay period and filling out the annual, quarterly reports with the IRS. So all that is being done. So the federal income tax, your Social Security tax, your Medicare tax, all of that is coming out on the front end. I don't know if you're like me, but when I got my first job back in between, I guess, junior year and senior year of high school, I got a job with the Public Works Department, and I was making, I think, $8 an hour. But I was really happy because I got 40 hours a week. So I was working 2 weeks, 80 hours, $8 an hour, $640. You wait 2 more weeks to get your paycheck. Paycheck finally comes, and it was like $490. It's like, what happened to the other $150? Who's this FICA guy taking all my money? And who's SS and MED? What do these mean? Well, that was kind of nice looking at it, at the end of the year. But at the time, I was like, where's all my money at? Well, basically, they're withholding that money during the year. The IRS, they like their money, and they like it timely. You have to comply with, as an employer, those requirements, and they withhold it from your check. So you're getting the net amount. When you get to being a 1099 employee, and we'll just talk about the W-2 here in a minute here, but a 1099, you get that gross amount. So if someone says, we'll give you $800 to do this job, they give you $800, and they give you a 1099 that has $800 on it. However, as we'll see in a few minutes, we still got to pay those taxes, and as an independent contractor, you're going to have to actually pay some more. So as far as the W-2 goes, I'm pretty sure most people are familiar with those. You get those generally in January, maybe early February, and it reports your income for the year. You got those 6 boxes at the top that have the most meaningful information usually. Box 1 is what's going on the tax return. Box 2 is how much you had withheld. I think I have on the next slide here. Yeah, how much federal income tax withheld. And that's the total payments made to the IRS during the year towards your income tax. There are also boxes 4 and 6, which is the rest of that tax that I was talking about that comes out. And again, that's all calculated by your employer for you and doesn't impact your income tax return at the end of the year unless you overpay on one of those, which is unusual but possible if you work more than one job. But at the end of the day, you see that 6.2% and 1.45, so that 7.65% is just taken out of your check, and you never see it again until hopefully when you retire and get to enjoy some of the Social Security, and then they take some of that away. So hopefully it'll still be there when I get there in 30 plus years. But regardless, yeah, I know, I'm not holding my breath. So these are taken out, that 7.65, and additionally, your employer is matching that. They have to match it as part of IRS regulations. So the IRS is getting 15.3% of your compensation throughout the year in each pay period. Now, when you do things yourself as an employee of your own employer, employer, if you're self-employed, I was a newspaper deliverer during high school and college as well, so I got a 1099, or if you're a real estate agent, I've got several of those clients here, you get a 1099 at the end of the year. And there's several different 1099s. People say that word a lot, and there's actually several more that are on here. We got interest, dividend. You got 1099B, which if you have like investments with a broker, that breaks down your gains and whatnot. 1099R if you're retired, you have a distribution or a rollover. You got the 1099 SSA if you have Social Security income, 1099G if you have an income tax from a state. But the one that we're interested in today is a 1099 miscellaneous income, and it's a pretty plain form. Usually in box 7, you're going to see miscellaneous income, and that's essentially if you're like a real estate agent, if you have closing costs from a broker, say $30,000, And that's how much you got after each closing altogether. That number is going to be pasted on there, and that number is also being reported to the IRS. So they know that's how much income you had. So you're going to have to put it on your tax return. However, what's nice about being a 1099 employee is you get to have some deductions to offset that income. So hopefully we've got some mileage or cell phone fees or dues or MLS fees, et cetera, to offset that income so we can reduce how much is actually taxable. So again, you're not an employee, but that income is subject to SE tax, as I was mentioning earlier. Since during the year, nobody's taken out that 7.65 from your own check and your employer is not paying it, you have to pay both sides. So that is a big hit. Right off the top, 15.3% of your net amount. You do get to offset your deductions or the income with your deductions before that amount is calculated. And you're also, as being self-employed, eligible for a new deduction in a nutshell that is worth 20% of your net income from that business. It's a whole lot more complicated than that, but we're going to stick with that for now. We'll talk a little bit more about it later. But this was a new deduction in 2018 that the IRS gave out essentially because the corporate rate went down from around 35% to 21% flat rate. And so the corporations had a big advantage over proprietors and partners and partnerships and whatnot, because if they're getting taxed at their individual rates, that might be as high as 37% now, and the corporates are getting taxed at 21%. There's a big gap there. And so in order to stay competitive, the IRS gave a huge deduction to all those that are eligible as with self-employment income. You do have to pay estimated tax payments. That's one thing that's kind of a hassle if you don't have an employer taking those deductions out each pay period, each quarter, et cetera. If you end up with a balance due of over $1,000 at the end of the year, you're going to have to pay some penalty and interest on it unless you're making estimated tax payments to offset it. So say your balance is $10,000 at the end of the year because of your self-employment income, nothing was withheld, then you can make $2,500 quarterly payments. April 15th, June 15th, September 15th, January 15th is when those are due. If you make them all timely and you come out to $10,000, you break even, no penalties, no interest, and you just roll on for another year and keep going. So it is something to keep track of. The IRS, we actually have our tax software can take those out automatically for you. We can draft them if you give us your bank information, then one less thing for you to have to think about. But we do advise making those if you are self-employed and do have that net income at the end of the year. Any questions at all? Yeah, yes, ma'am. Well, then you're generally okay. Again, yes. As long as you have paid in at least as much as you paid in the prior year. It's a tad bit more complicated than that, but that's in a nutshell how it'll work. The IRS realizes there's changes and things happen. But if you do know that is coming, you can make estimates, even if it is your first year. But good question. Mm-hmm. You got it? Penalty? We will get to that here shortly. It's interest based on what you should have paid quarterly, and they adjust it throughout the year. But we'll look at that in a little bit. Yes, ma'am? Well, it depends on, I'm sorry. The question was, if you are claiming mileage on your tax return and you were to wreck the car and it gets totaled out, then what is the impact on your tax return? It depends on how you're handling that asset. So if you're just taking mileage, then you haven't depreciated that asset at all, then it doesn't really come into play. You just start your new asset. We start taking mileage on the new car or vehicle, and we keep going. Now, if you did get it totaled out, then we're going to have to potentially recapture some depreciation that we've already taken, and we're going to have to record any income that we had from the insurance potentially, and that'll offset the loss to some extent, and then we'll put in a new asset into service. So it just depends how that asset has been handled to date as far as your business goes. Correct. Included in your mileage is a depreciation piece. So the IRS is giving you some percentage of that. Last year was 54.5 cents. I believe 23.5 of that was towards depreciation since you're not taking it. And then the rest of that is for mileage, maintenance, oil, gas, things like that. So the IRS is already taking that into consideration when you're making that deduction as far as mileage goes. Okay. Anything else? As far as being self-employed or? and you withhold more. Yes, sir. At the end of the day, your rental income is nothing's being withheld on it. So if you don't have enough deductions to offset it, then you would potentially have a balance due at the end of the year. Yes. Yes, sir, Tyrell.
Michael online wants to know, how are taxes applied on a 1099-R for an IRA? Is it considered regular income, or is there a different scale for an IRA?
It is considered ordinary income. So the tax that you withhold will go on your total payments line and go towards any other income that you had withheld. Anybody else? All right. So that's being self-employed, estimated payments, filing your taxes. All right. So here's that penalty and interest. You beat me by a slide. You must file and pay your taxes by April 15th. And there are penalties and interest for paying late. Penalties are 0.5% per month with a max of 25% of the unpaid tax. And again, the IRS does that by quarter. So if you make an estimate, maybe a month late or so, there might be just a little bit of interest on that amount, but it's 0.5% on whatever gap you had. It's probably not too large, but we do recommend making them timely, and then you don't have to worry about it. You do have annual interest as well for penalty or for interest, and then you can file a time extension. But a very common misconception is that, okay, I don't feel like paying my taxes in April, so I'm just going to extend it. I'll file in October and be done. So the IRS still expects the money April 15th. You can file an extension. The tax return isn't due until October 15th, but you're still liable for that balance due on April 15th. So when we file extensions and we know there's going to be a balance due, we always ask to if the client wants to make a payment. We recommend making a payment. Usually, if we base that off of last year, we'll at least be in pretty good shape, and then we'll just adjust, maybe have a refund, and we can credit it or do whatever we want to do. But just by extending does not mean that the tax is not due that day. The IRS still wants it April 15th, and we'll charge you penalty and interest if you do not pay it by April 15th. The penalty for filing late is really big, 5% per month, max 25% of the unpaid tax amount. So that can get high real quick. So though we're going to talk later about voluntary compliance. I think it might be, voluntary compliance. Every citizen voluntarily files their tax return. Well, yeah, we don't really have a choice. If we don't file, the IRS is going to come hunt us down. They know that we need to be filing. So using the term voluntary loosely, but no one is, at our door saying you haven't filed yet, at least not for a couple of years. So April 15th is when, again, everything is due. There is, some terms that get thrown around. Tax evasion is when you intentionally don't report income or pay your tax, and that's not something we mess around with. We want to report everything we know about. However, we are into tax minimization. We don't want to pay the IRS any more than we have to. Any way we can to avoid tax, or we'd really like to defer tax if we have no choice, at least move those taxes down the road, and maybe something will come up where we can offset it. But we do our best to try and minimize that tax. The Lord said in the Bible, render unto Caesar that which is Caesar's, but he didn't say give him any more than he deserves. So that's what our goal is, to make him pay as little as possible, but stay in compliance with the IRS and keep him off our back. So there are the dreaded audits that come out with taxes. Usually it starts with a notice, generally, that maybe they're missing something, or maybe something didn't get reported right on the tax return. And if it goes to an audit, then you can have a few different kinds. You have a correspondence audit, which is done by mail. Basically say, hey, maybe you had a bunch of supplies. Let's see some support for those supplies. You send it back to them. Hopefully, oh, okay, looks good. They're done. Yes, ma'am? I will try. Yes, ma'am. I apologize. Yes. So you have an audit. Correspondence audit is done by mail, where they send you something, you respond to it. Usually they give you about 30 days. You can ask for an extension if you need to, and send back the information they request. Hopefully they'll be done, and you'll be on your way. You can also have a field or an office audit. Sometimes they'll come out to your place of business, or they'll ask you to the IRS office. And then it's a little more serious, and that's where really having a CPA with you helps a lot. We know what they're looking for generally, or we study and make sure we know what they're talking about. We have all the support in line. We don't give them any more or less information than they're requesting. It's what they ask for, and that's it, and hopefully take care of it. So those are the three different types of audit that can come up. All right, so now let's start getting into actual changes that took place between 2017 and 2018. From what I understand, it was the biggest tax change since 1986. I was born in 87, so it was the biggest one of my life. And there was a lot of changes, let me tell you. Okay, 86? Yeah. 87? Okay, yes. Yep. So a lot of changes. One of the most widespread changes affect every taxpayer was the income tax rate changes. So first off, in the U.S., we have a graduated tax system as far as the rates go. It's not a flat 10, 12, 24. It graduates. So the more income you have, the higher the tax rate goes. But what's nice about that is it starts kind of low at 10%. You can see when we compare between 2017 and 2019, 2018 was fairly similar as well, is the tax rates in whole went down. Other than the 10% bracket, this is for married filing jointly. It used to be 10, 15, 25, 28, etc. Well, as of last year, it went 10, 12, 22, 24. So you notice about a 3% rate deduction from the 15 to 25. Even the 28 went down to 24. And looking at those as well, you can notice there, especially of the 24 versus the 28, the bracket got a lot wider. So there's more income being taxed at a lower rate. So basically, everybody across the board got a tax break just right there because the rates changed, both going down and making those brackets wider. So that was a big help for most people, basically everybody that had to help. The single filer, very similar, basically cut in half of the married filing jointly. Not exactly as you get to higher brackets, but they also, the tax rates themselves went down as well. And now let's look at an example. I talked about having, oh, I'm sorry, yes, ma'am? Very good question. She asked if you're being taxed at the tax rates, the ordinary income tax rates we just looked at, as well as the self-employment tax rate. The answer is yes. On your self-employment income, when you get to the net amount, so say as a real estate agent, you have $30,000 of income, $10,000 deductions, you're at $20,000, right? That's subject to SE tax, so that's 15.3, so about $3,000 right there. And then that 20,000 moves over to the, we'll look at a little bit later, the first page or second page now of your tax return. And that is also subject to your income tax rate. So even if you're in the 10% bracket, you're getting taxed 25%, 25.3% on that income. Yeah, it hurts a little bit. So in this example, any other questions before I move along? You do, yes. This is not, yeah, you're not taxed on that exact amount. That plays into your income taxable or adjusted gross income. And we'll make our way through the line. You have that handout there that I gave you, the federal income tax summary. We'll kind of look at that here in a minute and see how this all feeds in there. But as far as those graduated tax brackets, this is, yes? 7.65. Mm-hmm. And you do get to deduct half of the employer, or really the entire employer part from your adjusted gross income, or from your ordinary income to get to the adjusted gross, which we'll look at here in just a little bit. But it's not as bad as it sounds. And you generally, since you're getting that gross amount, you're probably making a little bit more. You are making more than you would if you were an employee. This example here just kind of displays exactly what I mean about the graduated tax rate. So if you were single and you made $150,000, at the end of the day, since all those portions of your income are taxed at different rates, you only get taxed $30,175. You're in the 24% tax bracket is what you'll hear a lot, but what does that mean exactly? That just means that every dollar after that is taxed at 24%, but the dollars before that, as you can see on the slide there, are taxed at less, to result in a savings of about almost $6,000 if you were taxed at a flat rate of 24. And we'll look at all this as well just a little bit later, but what we're talking about there is your marginal rate, which is the tax bracket that you're in this case 24%, where every additional dollar is taxed at 24% versus your effective rate, which in this case is more like 20%, 30,000 divided by 150. So you're only really paying 20% on that 150, even though you're in the 24% tax bracket. You want me to run back through that? Okay, let me show you here. Let's start at the beginning. So right here, this is where we start. The first $9,700 taxed at 10%. The next $30,000, give or take, is taxed at 12%, or $29,774. The next $44,000 is taxed at 22%. The next $65,000 is taxed at 24%. So each portion of that income gets taxed at different rates as you go into those different tax brackets. Yeah, that's what those calculations are. So this 84.2 has already been taxed at these rates. So now the additional 65.8 is taxed at 24. Yes, no problem. So if you made it to 170, another 20,000 would still get taxed at 24, essentially. Clear as mud? Makes sense? That's what you have us for, right? Any other questions on that? Yeah. All right. So another tax that you might come into contact with, you probably hear a lot about, is your capital gains tax. Now this is based on the profit from the sale of an asset. So you might have stocks, bonds, a piece of property, some land, etc. Well, if you sell this, these have different tax rates, and it depends on the length of time that you have owned that asset. So if you have an asset for 1 year or less, it is considered a short-term capital gain, and it's subject to your ordinary income rates. So that individual we just looked at the $150,000 single individual, it'll be taxed at 24%, depending on how much how much gain that is, depending on if we get into the next bracket or not. So it just adds to your ordinary income. However, if you have it for more than 1 year, then we get some preferential tax treatment. And that is all depending on how much your other income is. So for example, if you sold an asset, had a cost, you paid $50,000 for a piece of land. Well, in the last 2 years, it went up and you sold it for $100,000. Now you have $50,000 gain, right? That's your profit. Well, assuming no other expenses related to that sale, and you have no other income of any kind, at the end of the day, you're going to pay 0% tax on that $50,000. But if you sold that in less than a year, it would be subject to those tax rates we were just looking at. So holding the asset for an extended period of time can come in handy when it comes to paying taxes. Now, as your income goes up, because you might have some other, if you were working a job, you have ordinary income, then that capital gain gets added to your other income, and it starts getting taxed at either 15% or 20%. But at the end of the day, still 0, 15, 20 is less than the tax rates that would ordinarily be in. So there is some preferential tax treatment there. Any questions on capital gains? That's a pretty high overview of them, but that in a nutshell is how they work. All right, so now if anybody happened to look at their tax return last year, it looked a lot different. The first page of the 2018 tax return is just information, basically your name, address, your filing status, and whether or not you had health insurance. Whereas the first page used to have 37 lines, and then page 2 had another 30, 40 lines or so, all the way up to like 78, I believe. 2018, there was only like 18 to 20 lines. So they changed big time and essentially summarized the tax return on that page 2 versus what we used to have with all those different lines. All they did really was a political move, because they just added, yeah, sort of. They still added 6 schedules in order to take all that information that used to be reported on lines 1 through 70 and put them on those schedules. So it really didn't make anything that much easier, but they could say at least that, hey, it's so simple, it's on a postcard, anybody can do it, right? Yeah, okay. Anyway, so that's some of the significant changes just looking at the tax return itself. But I'll hit these schedules here, and then we'll talk about some more details. So we've already mentioned a few schedules, but Schedule A is where you report your itemized deductions. And we'll talk about the difference between an itemized deduction and taking the standard deduction and how that comes into play. That's probably one of the most common questions I get. What can we itemize and how does that affect things? We'll talk about that here in just a minute. Schedule B has your interest and dividend income. Schedule C is where we show that profit or loss on the 1099 that we discussed earlier. If you're self-employed and you have your own business, we're going to show that on Schedule C, our income, and then we're going to calculate all our deductions so we can hopefully get that income down pretty low and not have to pay much self-employment tax or income tax on it. We also have Schedule D, which shows the short and long-term capital gains. We're just talking about capital gain taxes. That's where we report those, our purchase price, our sale price, any expenses associated with it, and then the net amount that gets moved over to your tax return. Schedule E shows the rent income and expense this gentleman mentioned earlier, where again you get the net or the gross amount of rent, say $10,000, and then you paid some property taxes, you paid for some repairs, we're depreciating that house. So all those are deducting against the $10,000 to get us to a net amount. And then similarly, Schedule F shows the income and expenses related to farming. So if you have some corn or some hay or whatever you're farming, that's where we report the income and the associated expenses. And those all feed to your tax return. All right, so let's get back to some changes here from 2017 to 18. This was a huge one. Personal exemption, 2017 was $4,050. 2016, I believe, was $4,000. The personal exemption is for each individual and dependent in your tax return. So for me, I'm married, and I've got 3 kids. So I had 5 exemptions. So that's $20,250. So as soon as I found out that those were going away, I was like, oh boy, I'm in for it now. And that's what this does. These exemptions, they offset your adjusted gross income. So the income from your wages, the net income from that Schedule C, it's all added together, and then you get to add some deductions here to kind of reduce that before we figure out how much tax we owe. Well, 2018 to 2025, those are all gone now. Those exemptions, it doesn't matter if you have 12 kids. It does not impact this deduction because it's gone. There's no more personal exemption. We'll talk a little bit later how the IRS kind of offset some of that and made up for it. But that was a big shock from the beginning, and that's a huge change. That's been, since as long as I can remember, we've had that deduction. And then alimony payments, another pretty big change. 2017, 2018, and prior to that, if you were to get divorced and somebody's paying alimony, the individual that's paying the alimony got to reduce their income by that amount, and the individual receiving the alimony had to pay tax on that amount. Well, usually the person that's paying alimony is probably making more than the other individual, so the IRS apparently decided that they'd prefer that income to be taxed at a higher rate at the individual who's paying the alimony. So starting in 2019 and forward, it'll now no longer be deductible by the person paying it and no longer be reported as income for the individual receiving it. But depending on which side you're on, this might be a good thing, or maybe not, if now you don't get to deduct it anymore. So that was a fairly big change there as far as alimony goes. All right, now let's talk another huge change last year. Standard deductions basically doubled. The standard deduction is the amount that you get to reduce your adjusted gross income by that the IRS basically gives you. So if you don't have any itemized deductions, you automatically, in 2018, got to reduce your adjusted gross income by $12,000. And if you look at that handout that I have, you can kind of start following me down the line as I go through these. If you have that handout, you see your total income from different sources. You got your wages, your interest, your dividend, your IRA distributions, basically your retirement. That gets you your total income. Then you can have a few adjustments. This scenario that I have doesn't hardly have any in 2018. So we get to that number, that magic number, AGI, adjusted gross income. You hear that thrown around a lot. Usually people are asking for that if you're applying for a loan or scholarships, things like that. They want to know what your adjusted gross income is. Well, then we get down to the next little section of that handout, and we're going to start talking about deductions. So we've got our number there, in this case for 2018, $129,050. That's where we're starting. Now we get to start reducing that before we actually calculate tax. So the IRS basically doubled the standard deduction in 2017 to 2018. For single, it went from $6,350 to $12,000. Married filing jointly from $12,700 to $24,000. The IRS said, okay, well, we're not giving you those exemptions anymore, that $4,050 per person that we gave you in 2017. So we're going to go ahead and double your standard deduction to give you a little bit of a break there. I think the other portion of that was the IRS is trying to make things simpler for everybody. And when it comes to itemizing, it can get a little complicated. There's a lot more to report. Sometimes it can get a little gray as what we can deduct and what we can't. And so this, I don't remember the exact percentage, but it reduced, I know in my personal clients, it reduced the amount of people itemizing pretty significantly. It used to be, again, if you were married and you're trying to get to $12,700, you can deduct things like mortgage interest, property taxes, charitable giving, all those things, and we'll look at these in just a minute. It wasn't that hard to get to $12,700, really. But now, 24, that's a pretty hefty mortgage interest, property taxes, and charitable giving to get there. So the IRS's goal, again, to make things simpler, if everybody just takes a standard deduction, then they can pretty easy to fill out a tax return if you only have a W-2 and nothing to itemize. So personal property, yes. Your personal residence, your primary and your secondary. Yes, yep, and we'll get to that. Just in general, the standard deduction and how that works here. Now let's talk about the itemized deduction. So if you're looking at that handout that I have there, you'll see about halfway down, this individual had some itemized deductions. Then you get to the tax computation where it has the standard deduction. And the line below that says the larger of itemized or standard. This is where a lot of people really don't know how things impacted their tax return. The IRS, again, in 2018, they gave you $24,000 if you were married filing jointly here. So all those deductions, like the gentleman mentioned, for the property taxes, mortgage interest, charitable giving, if those, in this case, you'll see, if those all together add up to $23,600, the standard deduction is still higher. So that those essentially don't help you on your tax return. They don't make a difference because we're obviously going to take the larger amount versus the $23,600. We'll take the $24,000, but that's given to us. So really all those things that people try and add to, their charitable giving, their goodwill and stuff like that. If we can't get higher than the standard deduction, then they don't help us. And we'll talk in a minute about how some ways that we can maybe help get over that threshold, especially in this scenario where they were really close to itemizing. But before we go too far, let's talk about what we can itemize. What makes up those deductions on our Schedule A that allow us to maybe exceed the standard deduction? So we'll start off with medical expenses, another one that's commonly misunderstood. So if you go to the doctor, you get to deduct that right off the bat, right? Not quite. There's a floor on there. In 2017 and 2018, your floor was 7.5%. So what does that mean? Well, if you have adjusted gross income, we'll make it nice and round and make it easy, $100,000, right? Well, 7.5% of that, or $7,500, is the floor. So your first $7,500 don't count. They don't help you one bit. And then if you get over that, say you had $10,000 of deductions, only $2,500, the amount over the $7,500, is what we get to deduct. But that only gets added to our Schedule A. So it's not in addition to our standard deduction. It is in addition to our other taxes, contributions, etc. And if those numbers don't get over the 24 combined, again, it really doesn't benefit the tax return. I mean, I know you paid them. I know it's not because you had to pay them, but it doesn't help you at the end of the tax season. State and local taxes. We had a pretty big change from 2017 to 2018, where in 2017, there weren't any limits on property tax and sales tax. We could add them up together. You have $10, $15, $20, $30,000. And if you're at that point, you're already itemizing because you're already over the $24,000. Well, in 2018, they put a cap on that of only $10,000. Now, Tennessee, that might not have had as big of an impact. Property taxes is probably one of the main things in this area, and they're not that high around here. But my brother in Illinois, he's got about 0.1 acres, maybe 1,800 square foot house. He pays about $6,000 property tax every year. And then additionally, he's got income tax in Illinois. I believe that's 3%. So when you added those two up, he itemized every year, and just because right there, he's probably got $10 or so thousand. Whereas if you're over that, especially if you're in California or in New York or wherever, and you have a big old house, downtown, you're probably paying $20,000, $30,000 of property tax. Well, now it's capped at $10,000. So this impacted them heavily. There was all kinds of legislation to try and get around it. But as far as I know, there was no way around it. So that's something we have to keep in mind when we're strategizing as far as our itemized deductions to make sure we don't exceed that $10,000. And next we got mortgage interest. This one's fairly cut and dry. On your primary or secondary residence, you get a letter at the end of the year from the bank. They usually have the mortgage interest, sometimes property taxes, and the mortgage insurance paid on that item. So we get to add that. We get to deduct that on your primary and secondary residence. And then lastly, charitable giving. This one is kind of where we can also do a little bit of, I won't say manipulating, because that sounds like we're doing something wrong. But as far as charitable giving, when we give those donations, is where we can make a little bit of an impact potentially between years if we're really close to that itemizing amount. So what is charitable giving? Well, it's a gift by cash or check to a nonprofit religious organization. Those are kind of the easier ones. You can also have a gift other than by cash or check. So if you're donating to Goodwill, or if you donate a piece of property or donate some kind of good or service, then you can potentially deduct that as well. And there's different reporting requirements. I won't go into too much detail on those. I've got kind of the breakdown on your handouts there. But we get to add those to our other itemized deductions amount. We get to add that to our mortgage interest, to our property taxes, to our medical expenses. And at the end of the day, if that Schedule A amount, again, is more than our standard deduction, then we get to take the greater of the two. Here is a big change from 2017 to 2018 as well. We used to have unreimbursed employee expenses that we could deduct, as well as some union dues and remember those things that we were talking about. If you're an employee, you don't get to deduct those expenses against your W-2 income. Well, in some cases, say if you were like a vice president of a company and you have to manage like 8 different branches around the state of Tennessee. Well, if you're driving your personal car and they're not reimbursing you for that, you used to be able to deduct that as an itemized deduction on your Schedule A, as long as you were over that 2% floor. But in 2018 and forward, as long as we know, that deduction is gone completely. They just repealed it. It's not even on the Schedule A anymore. It's just gone. So that had a fairly large impact on several types of employees. Gambling losses are still deductible up to the extent of winnings if you can itemize. So they didn't take that away from the gamblers. So apparently they have a good lobbyist, I guess. All right, one more thing we'll talk about, and then we'll kind of look at this handout in a little more detail. talk about deductions versus credits. So a child tax credit, I told you earlier we got rid of those exemptions, which had a pretty big impact on people with several kids. Well, the IRS made up for that to some extent here with a credit. It used to be in 2017 $1,000 for each child under the age of 17. 2018 to 2025, they actually doubled that to $2,000 per child under the age of 17. And now that's a credit, which is different than the deduction. We're just talking about deductions. If you look at that handout, you'll notice that deductions are taken before you get to taxable income. So your tax is based on that taxable income amount. So it's basically a percentage of that amount is what's actually being deducted. You're not getting the benefit of a $10,000 donation. If you're in the 22% bracket, you get $2,200, not the whole $10,000. Whereas a credit completely offsets the tax. If it's a $1,000 increase, so a $2,000 credit, we're reducing our tax by $2,000. Let me clarify that. Okay, let me get to the next. This one might help you. Okay, here. So a deduction reduces your taxable income. So you have, if you look at your handout here, do you have the handout? Okay. If you look at your handout about 7 lines down, 8 lines down, you have your adjusted gross income, $129,050. Well, then we're going to start talking about deductions. And you get down to, what line? I wish I had line numbers. But probably about 5 lines below that, you get to your taxable income, that 105. Well, that taxable income is where our tax is being based off of. So if you're in the 12% bracket, they're multiplying that 12% times that taxable income number of 105. Exactly, before you get to taxable income. So what that's doing is reducing it by a percentage. Because if you're in the 22% bracket, it's only reducing it by 22%. Whereas if you look just a little bit further down, you got credits. We've already figured out how much tax we owe. We owe $14,955 a tax. But if we get a child tax credit of $2,000, we only owe $12,955. So it's dollar for dollar. So a lot of people, I run into 2 scenarios generally with this. It usually comes down to your itemized deductions. Maybe you're thinking about giving to a nonprofit organization or something along those lines at the end of the year. Okay, well, you're right at that threshold. Maybe you're at $24,000 and you're married. So right now, all those other deductions aren't doing you any good because you already have the standard deduction. Well, what if I give $5,000 to a nonprofit? Well, now you're over that. So we get to itemize. But that $5,000 comes off of the taxable income amount. So if you're in that 22% bracket, you're really only saving, about $1,200 or so, a little over $1,000. I mean, that's not bad. I mean, at least we're saving some tax and we're giving to a good organization. So, everybody wins. But I do have some clients that if they own a business and they're going to take a deduction before the end of the year, maybe they'll buy a piece of equipment or they'll buy a new truck. You see these people that every other year, it seems like they're buying a new truck. Say, it saved me on my taxes. Well, it might have saved you. Maybe you paid $30,000 for it. So you saved, $6,000 of tax. So if you didn't need the truck, you still paid $24,000 that you didn't need to spend anything on. So we do recommend buying assets if you need an asset. If you're looking at purchasing it December versus January, that's where we like to plan with our clients. Let's see how you're sitting at the end of October. And hey, we got a good year. We got $50,000 of income, net income. Well, we don't want to pay self-employment tax. We already heard that's not fun. 15.3 plus your income tax. So maybe we'll buy an asset. We got to buy a tractor this year or next. Let's buy it this year and we can save all that tax. But if we're sitting there, we're already at break even, we're almost giving away our deduction by taking that when we didn't even need it to begin with. So just because it might help you as far as the deduction goes, doesn't mean it's dollar for dollar. So we're always looking for credits if we can get them. And I don't recommend having a child just to get a $2,000 tax credit either. I assure you it's not cheaper, but it does help you dollar for dollar at least. So you can take that or leave it. I don't know if there's a list. There is a list. There is a list. Okay. They're probably getting smaller and smaller all the time now. I think are the residential credits even around anymore? Energy efficient. A little bit of property, like solar property, I think. But yeah, they keep getting rid of those credits. I can't imagine why. Okay, so the next one, we had another change, pretty big between 2017, 2018. The ACA Individual Responsibility Payment. Affordable Care Act. Good question. Obamacare. Yes, thank you. Obamacare is how it became widely known. So if you did not have health insurance or you did not have Affordable Care Act compliant insurance, which was me for a couple of years, then you had to pay a penalty when tax time came around. And it was a pretty steep penalty. In 2018 and 2017, it was $695 per person, or 2.5% of your household income. So it was a 1095 thing. Yes, there was 3 different types. You have a 1095A if you had the marketplace, 1095B if you had an employer, and 1095C. You got one too? Retired military, yeah. Yes. So you get a 1095 to report to your tax preparer. Now in 2019, that penalty is repealed completely. So correct, not backdated, which makes no sense because they enacted this law at the end of 2017, but they said you can still pay the penalty in 2018, even though it's going to be gone in 2019. So believe me, I was not happy about that either. But anyway, I can't change the law. I just got to follow it. So that's gone for next year. Now, you might still, if you have health insurance through the marketplace, you get a 1095A at the end of the year is based off your household income if you got a credit or a prepayment of that health insurance. So you might not be done necessarily with your medical as far as taxes go, but if you didn't have health insurance, the penalty has been repealed. So 2019 and forward, as far as we know, indefinitely, that penalty is gone. All right, let's talk a little bit again about some of the deductions for self-employed individuals. So this is a brand new deduction in 2018. I'll just hit on this a little bit. We spent hours and hours and hours researching this deduction. There's not a whole lot of guidance on it, especially not initially. There's more now. But in a nutshell, if you have Schedule C, if you're a proprietor, your income is less than $315,000. If you're married, you can get a $20,000, or I'm sorry, 20%. 20,000 would be really nice. You can get a 20% deduction on your qualified business income, which should keep things relatively simple. If you're a real estate agent, again, or any kind of sole proprietor, you get a 1099, you get $10,000 in net income, you get a $2,000 deduction like that, right off the bat. I mean, of your net amount, and you have enough taxable income as well. It's based on the lesser of your qualified business income with real estate agent, the net. So again, if you had 30,000 gross, 20,000 deduction, 10,000 net, that's where the qualified business income deduction would start, would be that 20%. Yeah, it's not as good as it sounds, but it's better than nothing. It's better than nothing. And some people, we've seen. Yeah, $8,000 deductions, nothing to sneeze at, and it's basically a free deduction, if you will. Some of those deductions I've had in the past, you had to buy energy efficient windows or energy efficient HVAC. You had to buy something to get the credit, whereas this deduction is just for having a qualified business with qualified business income. So again, it must be from a trade or business within the United States. Investment income doesn't apply, and reasonable compensation from an S corp or guaranteed payments from a partner are not subject to this. But this is just the net income on those qualified businesses. So this deduction is used in computing your taxable income, not your adjusted gross income. So that would be kind of a moving target if we use that. But this is that number we're looking at here. After you get to your adjusted gross income, the qualified business income deduction is right after that, before your taxable income. So again, it's reducing the tax by a percentage. It's phased out again completely for those over 315,000. It begins, ratably once you get to 315, and then at that point it gets way more complicated. But there's no reason to really get into that here. But correct. Yep, exactly. I had a question over here. Nope, not quite. The 157.5, or the question was, if between 157.5 and $315,000, if that's where the phase out begins for the qualified business income deduction. Now that is the difference between single and filing jointly. So if you are single, the phase out begins at 157.5. If you're filing jointly, it begins at 315. And I believe it's a $100,000 window as it phases out throughout that window. So if you get over 415, that's when those limits start to come into play. I had the last point on that previous slide, where if you're above that threshold, if you get over 415 for a joint filer, then you have to there's some other exceptions, if you will, or limitations on that. And I'd be happy to talk with you afterwards. There's not very many people that it applies to, so it's a case-by-case basis in every case. But again, we spent hours and hours looking into this, and we'd be happy to share some of that intel if you'd like to know. Now, there are some people that are completely excluded from it if you're over that threshold. You notice the first one on the list is accountants. So for whatever reason, we don't get this deduction, even though we're like the only ones that know how to calculate it. They don't want us cooking the books. That's a good one. As long as we keep it under our income under 315, anybody, if you're married, filing jointly, if you have under 315, even all these people, doctors, lawyers, basically professional services, can still take the deduction. And once you get over that 315, if you're married, it really starts phasing out, and it'll be completely phased out once you get over the threshold completely. There's that, and then I'm going to just give two quick examples here in a second. Let me get at the taxable income limitation. It's based on the lesser of your qualified business income or your taxable income. So if you had a big loss somewhere else, you can't take 20% of the qualified. You have to take 20% of your taxable income there. So an example here, just kind of to show how that works. If you had a married taxpayer, $250,000 taxable income, so they're below the $315,000 threshold. They have $100,000 of qualified business income. They get a $20,000 deduction. So that's a pretty significant deduction. If they're in the 24, 28% tax bracket, that's $8,000 or so dollars. Not bad, not bad. Again, for basically nothing. That's just a new deduction. Now, as we just discussed, if they have a taxable income of $60,000 but qualified business income of $100,000, so they had a $40,000 loss somewhere to offset their other income, then it's based on the lesser of the two. So they only get a $12,000 deduction rather than a $60,000 deduction. I'm sorry, rather than a $20,000 deduction. I believe that's all I have there. Does anybody have any questions, comments, concerns? No negative comments, hopefully. Yes, sir. Great question. He asked if he was taxed on his Social Security. Yes or no? It depends on your other income. So there's a graduated system for Social Security as well. If you have no other income, you aren't taxed on your Social Security. That's the easy answer is no. If you start having other income, it starts getting phased in. It'll be the most it can be taxed at is 85%, depending on your other income. And then I believe 50%, there's a range in there that equates to taxing the Social Security portion at 50% being taxable. But it really depends on your other income to define how much of that is taxable. So it is subject to tax. 50,000 and depends on your Social Security income as well. In that case, I think you'd probably, are you filing single? In that case, I think you'd be in the $85,000 range, or the 85% range. I can get back to you on that one for sure. Yes, Tyrell.
Michael online had a question regarding home.
Okay.
He wanted to know if the home equity loan interest with it not being deductible, what if the first mortgage is paid off? Would that allow the home equity interest to be deducted since that loan moves into first place with the bank?
No, sir. I don't believe it is. Is that right? It's not. It has to be either to buy or to improve the residence, the principal residence. Yes, sir. Mm-hmm. Required minimum distribution. Yes. Yes. Ron just mentioned that he is required, once you get over 70 and a half, you have traditional IRAs out there, you have to take a required minimum distribution each year. Now, if you want to donate, like Ron said, some of that, or maybe you intend to donate it anyway, maybe you get it and you're already going to give $5,000. Well, if you did that, that would go into that Schedule A, that itemized deduction of $5,000, which might help you, it might not, especially if you don't itemize. But there is an option to give a qualified charity right through your trustee, whoever has your retirement account. You can designate for them to give $5,000 to that charity, and it won't even come into your taxable income. So if you had a $19,000 distribution and he said, I want to give $5,000 to XYZ charity, Well, he'd only have $14,000 of income to report at the end of the year. So that's a good option. If you have to give it away and you're planning on giving it away anyway, you can just completely exclude that from your income and not have to pay any tax on it. So good point, Ron. I mean, that'd be perfect if there were no tax implications. It is tricky, yes. Yeah. Yes, ma'am. Mm-hmm. It's based, the question is, if you were to purchase a house and you're going to improve it, but not be able to sell it until next year, say you bought it in 2018 or 2019, make it easy, you're not going to sell it till 2020. The question is, do you get to deduct those expenses, I believe in 2019, was that your question, or nope? You have to wait. So it follows the sale. So that's what we were talking about earlier with those short-term versus long-term capital gains. When you report that sale, that's when it gets reported on the tax return, because that's when you had a reportable event with the IRS. Say you sold it $200,000, bought it for $100,000, you put $25,000 in 2019, $25,000 in 2020. So it's a total of $50,000 of improvements to the $100,000 you paid for it. So your basis is $150,000. Sold it for $200,000, so your gain is $50,000. But all of that gets recognized in the next year when you sell it. So 2020 in that case. Okay. So even closing costs, correct? Nope. You got it. You save them until the end. So it won't help you. It does. You'd have to have some capital there to offset that because you're not getting any benefit until you sell it. So that is correct. Anybody else? Sufficiently confused? All right. Well, we're free all year long. Please, if you have any questions, shoot me an email. There's several here that can help you with any questions. Oh, one more question. Yes, ma'am. Yeah. Well, if we had that crystal ball, then we'd probably be in a different profession. But we don't know for sure. But we're aware of red flags, things we try to avoid. So that we try and steer our clients in that direction. But I mean, some people, we almost know they're going to get audited just because of the type of business they do. Not that they necessarily did anything wrong, but not necessarily. If they've got a lot of expenses that are maybe hard to validate, if they don't have maybe employees where they're reporting 1099s or W-2s for the year, where the IRS isn't as aware of those deductions, they might come up as a little bit more subject to audit. Or if they're always showing huge losses and taking those to offset their income, that might throw up a red flag. But what are some of the red flag items? I mean, I could say, usually I kind of point them out as they come up. What are red flag items was the question. But again, one would be if you're always having a loss on a business, you're supposed to have a profit motive. If you have a Schedule C, 5 years. So if you're always, you have this farm, but you're buying tractors that you're using personally and you're always showing a $50,000 loss, you might want to be careful with that one, because at some point the IRS is going to say, you're not, this is just a hobby, and they're probably going to offset or not allow those deductions. Yeah, he's pretty good at that. So that's a little bit, but I don't want to keep everybody, we're past our time here, but thank you all again for coming. And if you have any questions, feel free to see us afterwards.
Thank you, David, for